Dear friends, hello. I'm really grateful that you've come to my channel. Today, I want to discuss a very real topic with you. When the so-called stable and profitable real estate investment is no longer the priority, more and more people are turning to other investment markets. Interestingly, among the many investors flooding into the market, there are only a handful who really make a profit. You might want to ask, is it all the market's fault? In fact, not entirely. The truth is that our success or failure in the investment market is, most of the time, deduced from our behavior. We need to realize that all kinds of human behavior are filled with complex psychological and social factors. Only when we truly understand our psychological preferences and tendencies can we move forward fearlessly in the financial market, outdoing others, and even outdoing ourselves. Today, I want to share a book with you, Behavioral Finance and Investor Psychology. This book deeply analyzes the psychological elements that could affect us when we make investments. It helps us acknowledge these psychological biases and teaches us how to correct them to make more rational investment decisions. The author of the book, Professor John R. Nofsinger, is a highly respected scholar and expert. He is a finance professor at the University of Alaska Anchorage, who has provided research services for numerous private enterprises, the New York Stock Exchange, and multiple policy think tanks. His research field is very extensive, covering capital markets, decision-making, and behavioral finance. He has published more than 30 influential papers in financial magazines and business journals. In this book, Professor Nofsinger points out that investors are usually influenced by their own psychological and emotional factors when making financial decisions. It's only when we learn to identify our inherent biases and know how to deal with them that we can make rational operations and avoid unnecessary mistakes in investments. I'll talk about the highlights of this book around several main topics. The first is how to accurately understand the impact of psychological bias on investment. A key element is the disposition effect, describing that investors tend to sell profitable stocks too early and hold losing stocks for too long due to the desire to avoid regret and the satisfaction of success. This is a very common psychological phenomenon. Study shows that the probability of investors selling profitable stocks is much higher than that of losing stocks. Next is the endowment effect. It's a tendency where people often hope to sell at a higher price than they bought it for, or would rather keep their belongings to avoid the possible transaction. This effect is often a manifestation of people's reluctance to change the status quo, and investors are no exception. Let's now talk about mental accounting. People often divide different types of financial activities into different mental accounts in their brains and make consumption decisions with emotion support. This habit leads us to have different spending behaviors when facing income from different sources, such as we are more likely to spend unexpected money, while we are more thrifty with fixed income like wages. Secondly, the author explains how to correctly view the impact of cognitive errors on investment. For example, the problem of overconfidence often leads to people overestimating their knowledge and abilities while ignoring potential risks, thereby reducing their investment returns. Another example is gambler's fallacy. People are more willing to take risks when they are profitable, but are often overly conservative after a loss. Lastly, we would focus on the role emotions play in investment decisions. They are an indispensable part of rational decisions. For example, changes in the external environment, like sunshine or a team's victory, can subtly affect our investment decisions in an imperceptible way. That's the main content of this book. I hope my sharing today will give you some new insights and thoughts. Let's continue to explore and learn in the field of investment, fully utilize the knowledge of behavioral finance and investment psychology, fight against psychological biases, and improve our investment abilities.